Hey everyone, welcome back to the channel. It is time for episode 6 in a series that I really love doing. It's where I review some top income oriented fund managers. So fund managers that have a lot of covered call ETFs and other income oriented funds. So this is episode 6. I covered BMO Harvest, Middlefield, Hamilton, Brompton, and now we're going to take a look at Evolve ETFs, a lesser known ETF manager on the Canadian side in Canada, but they have a total of 7 covered call ETFs, including a brand new real estate covered call ETF, which is actually the first of its kind. So very, very cool and unique covered call ETFs, guys. And I had the privilege of speaking for over an hour, I think, to the CEO of Evolve ETFs, Raj Evolve. Really cool and nice guy. Some great conversation. I don't hold back on the questions. So what we'll do in this video is quickly check their 7 covered call ETFs. Stay tuned because some of them are very, very unique and could be a great addition to your portfolio. And then we'll speak to Raj, the man himself at Evolve ETFs, and go through all the questions about their fund. So let's get to it. All right, everyone, Evolve ETFs. So let's check out their products here. And of course, I'm going to be sticking really and going over their covered call ETFs only, although they have other ETFs. So these would be these ones here, and they're the equity income. So they have 7 total, but they also have a few fixed income ETFs and some, some more growth or sector-specific ETFs, a lot of technology ones and some different ones like the metaverse and gaming. So I'm not going to go through these ones, but you could always check them out for yourself. They also have some, their own Bitcoin and Ether ETF, cryptocurrency ETF, and they also have cash savings ETFs as well. But in this video, of course, we're going to focus on the covered call ETFs, these ones here. So let's go through them one by one. The first one is Bank. Very, very unique ETF. So this is the Evolve Canadian Banks and Lifecos Enhanced Yield Index Fund. So this is the only one out of the 7 that uses both covered calls and leverage. So it's very, very unique in that way. So what it has, like you probably already guessed, is some Canadian banks and the life insurance company. So it's index based with covered calls and 25% leverage. The target yield is 7%, but it's much, much higher than that now. 10 holdings total. So let's check out what the holdings are right off the bat here. First, you'll notice that the management fee is 0.60, very, very modest, brand new. I mean, February 2021, it's fairly new here. And like I said, it's, it's kind of like the all-in-one ETFs that I really love, that Hamilton has and Harvest has, except this is not an all-in-one. It's just a portfolio of 10 stocks, and it's going to be the ones you expect, the 6 banks, and the life insurance companies, Great-West Life, Sun Life, Manulife. And they have also Power Corporation of Canada, which owns Great-West Life and Investors Group. So this really reminds me, reminds me of the LBS split share fund from Brompton. Pretty much almost the same holdings, except that they have another insurance company instead of Power Corp, but pretty much the same holding. So this is actually a great alternative to LBS. If you don't want the split fund, but you want the same thing that LBS offers, which is leverage and covered calls on a portfolio of Canadian banks and Lifecos. So very, very interesting here. If we look at the distributions, the yield is almost 11% here. I'm sure it's higher because this is only as of August 29th. So pretty sure it's over 11%. Right now. And if we look at the distributions, they've been pretty solid. They haven't changed, 7 cents a month. So that is the first one. Very, very interesting. The only one that has both covered calls and leverage. Next one is also a very unique one. It's BASE. Stands for Basic Materials, basically. And it's Global Materials and Mining Enhanced Yield Index ETF. So this one doesn't have leverage, but it has covered calls on it. And by the way, it Evolve ETFs kind of has a similar strategy to Harvest, where they do up to 33% of the portfolio has covered calls on it, and it's dynamic. So Base is very interesting. It's one of their bigger ones at 52 million AUM. It has 20 holdings here. And this is really an interesting one because, the management fee is also pretty decent, but there's not many materials covered call ETFs. So there's CGXF, there's the one from Horizons, but those are just gold producers, right? When it comes to materials, there's those ones. But this one is a bit different because there's mostly aluminum and steel companies in this one, as well as some miners, right? Like Newmont and a couple of other miners here. So very interesting. Goldfields, Royal Gold. I was trying to find them, but they don't just have gold producers. Actually, gold producers is a smaller percentage. What they have the most of is chemical companies and metal and steel companies, right? Like Reliance, Nucor, Steel Dynamics. So these are really the big cap. Rio Tinto. Here's some chemicals here, DuPont. There's the Dow as well. So very interesting basic materials ETF. I found this one is really unique. Really great performance. This is one of their older ones that's been around for a while. Exceptionally good performance. And what's also impressive, and this will kind of be a theme, and I'll be asking Raj about this, is that their yields on their covered call ETFs are a lot higher than the average. And they also, I know you guys will love this, they tend to increase their dividends over time. So this one here went from 16 cents to 20 cents this year in April. Which, you know, it's very rare that a covered call ETF could increase their dividend, but this one has, and you actually see it was 10 cents at one point, then 15 cents. This is in 2021, and then 2022 went to 16 cents and 20. So very interesting. This is base here, very unique if ever you're trying to look for some basic materials and you're an income-oriented investor like myself. This is also unique. It's the first ever covered call real estate or REIT ETF. I know there's RS on the middle field side, but that's actually a split fund. This is a legit, just regular covered call ETF, guys. Very interesting. A great option if you want a real estate ETF. And what I like about it, just came out. I don't even think they declared their first distribution. So you can see the AUM is very low. Target yield is 6%. I'm assuming this one will have 6, 7, or 8%, something like that. But what's interesting is that there's a lot of REITs in here, guys. Really cool. Management fee is 0.75%. It's a bit higher because it's actively managed, and they're doing this in partnership, or this covered call ETF is in partnership with Slate Securities. So remember Slate Office REIT, Slate Grocery REIT. So Slate are pretty much, you know, real estate experts. So they're partnering up with them. Very interesting. So if you look at the portfolio, you could see it REITs all over the world and all kinds of different REITs, right? Retail, diverse, office, healthcare, residential. So a really nice diversification here, magnificent diversification within the real estate sector. I find that was really interesting, and you could check out all the holdings here. Very interesting stuff here. So let's see, overview. Yeah, 0.75%. Do we have the holdings? I think we only have the top 10. Yeah, I can't scroll down here, but there's going to be a lot of REITs here. So this is basically brand new. It just started here September 21st, so we might not be able to see all the REITs inside. You could check out all the fact sheet if you want, or the ETF facts, but I don't want to make this video too long because we have an hour interview with the CEO. But very interesting REIT covered call ETF to keep your eye on. I know I said it's the first of its kind. It's not really true. Harvest has HGR, a REIT covered call ETF, but this one seems very interesting just because of the diversification. So keep an eye on this one. Very cool if you want some real estate and enhancement with enhanced income with the covered calls. Next one is call. So this one would compare to basically ZWK or HUBL. ZWK from BMO, HUBL from Harvest. So this is going to be your US banks, a covered call ETF. So it has the best US banks, right? You're not going to get any surprises when you look at the portfolio. Bank of America, Goldman Sachs, you know, Citizens, Trust, not only the giant ones, but all the big ones. You really, Goldman Sachs, JP Morgan, Wells Fargo, US Bank, Bank of America. So all the best, Citigroup, the best US financials in here with covered calls. Another cool fact is that you know, very high yield, much higher yield than HUBL, higher yield than ZWK. So this is a common theme again with the Evolve ETFs. They kind of have higher yields. Management fee 0.45, very attractive, a lot lower than, you know, the ZWK. I think it's at sorry, not Z, at 0.65, so 0.45, pretty low. And also in dividend increases. I mean, this is at 12.5 cents this year, but if you go back to 2021, you have 11.5. Very interesting, right? I mean, it's very rare that a covered call ETF raises their dividend at all. You see here, yeah, 3 months at 7.5 cents. I don't know what happened here. 11.5. So this is another one of their oldest ones, 7.5 in 2018. Now it's at 12.5. So really awesome dividend increases, high yield. probably over 10% now with this one here, the call, because this is a bit outdated. So this is your US banks covered call ETF, and this is also unique. They have a European bank covered call ETF. So this is 100% unique. There's no other European banks covered call ETF. I know BMO has a European dividend stocks and a lot of banks are in there, but this is pure European banks. Very, very interesting. 20 of them. Management fee 0.6. So you have all the best, biggest banks in Europe. I know there's a lot of things going on in Europe right now and England, but and I asked Raj about this. What gave them the idea to come up with this ETF? So very interesting ETF if you want some financials outside of North America, right? Because we always have the US banks, the Canadian banks, especially as Canadian investors. But this is a great chance and great opportunity to get an income-oriented European bank ETF. Very, very unique. EBNK. Really, really cool. And they also have a healthcare one. So this pretty much is competing with HHL, right, from Harvest. So it's called Life. This like call is one of their older ones. I think it's probably, if I'm not mistaken, their first ever covered call ETF. And what's interesting with this one, same types of, it's big, 224 million. So this is their biggest one by far. And again, what's always interesting is the lower management fees, which I asked the CEO about. So this has a much lower management fee than HHL, for example. You got the same kind of stocks. You have all the biggest and best healthcare companies. And also, if I'm not mistaken, if I remember correctly, yeah, you see it here, increasing dividends over time. I mean, 2022, you could see they increased the dividend 13.5 cents to 16 cents. Very, very cool. If you go back to 2020, it's 12.5 cents. Let's go back to 2018, 7.25 cents. So I can't wait for you guys to hear the interview, because I actually asked him, do you guys have some sort of genius covered call guy working on your staff? And it turns out that it's actually the case. Apparently they have a really good guy who knows what he's doing when it comes to covered call. So this is, very defensive. Of course, it's healthcare. Very interesting covered call ETF, once again by Evolve ETFs. And last but not least, this is kind of, an actively managed one called Lead, where they kind of have, financials and technology. Let's see. Yeah. So they have healthcare, finance, technology, and entertainment. So it's a mishmash of everything. There's a lot of technology stocks in here. They have some of their growth ETFs in here, as well as their covered call ETFs as well. So you see here Life, right? The one we just checked, the one we just reviewed. Call is here, the banks, but they have some of their growth ETFs are in here as well, like the cloud computing one, cybersecurity, the e-gaming one. So this is maybe kind of like an all-in-one covered call ETF with just a bunch of sectors and some different ETFs from Evolve. Pretty interesting. So I encourage you to come check out the website, everyone. You can check out the performance, of course, the distributions. But in my opinion, the ones that are very interesting and unique would definitely have to be base for basic materials. The REIT one that just came out, BILT, very interesting if you want real estate. So yeah, they have call and they have life. Those are more common. There's other providers. European banks, this is definitely a unique one. Might be a good time to pick up European banks, because there's a lot of fear going on in Europe and Britain right now. So this might actually be a good time to pick it up. And then they have the Canadian banks and Lifeco one, which is kind of like LBS split fund without being a split fund. So this is a really interesting option. If you want high yield and you're too scared of getting an LBS, bank would be a really, really cool option. So those are the Evolve ETFs, everyone. Pretty cool and unique. Now let's talk to the man himself, the CEO of Evolve ETFs. All right, I am very excited to have Raj on. He is the CEO of Evolve ETFs, a company that I've been looking at closely more and more, because they have a really cool suite of covered call ETFs, which is, as everyone knows, my bread and butter. So Raj, welcome aboard. Thanks so much for joining me today. Really appreciate it.
Thanks, Adrian. Thanks for having me.
So let's start by first maybe giving a little intro to yourself and Evolve ETFs. So, when did you start the company? Tell me a little bit about Evolve, a little bit about yourself as well.
Sure. Yeah. Well, I mean, you can see some gray hairs here. So I've been in the business for a while. Prior to putting Evolve together, I ran Canada for WisdomTree, which is one of the world's largest ETF providers. Prior to that, I ran the asset management, the retail business for one of the large asset managers here in Canada called Fiera Capital. And then prior to that, I built a structured products company with a couple of partners. We built it up to about $1 billion. ended up selling it to Fiera, which is why I went to go run their retail business. And then going all the way back, I started something called Jovian Asset Management, which was part of a mid-size financial services firm. And a lot of people probably haven't heard of Jovian, but Jovian ultimately was the company that helped incubate the Horizons ETFs. And I served actually as a director for Horizons. So when I left WisdomTree back in 2016, I tried to figure out what my next step was going to be. And what I decided was I really wanted to build an ETF business myself and put together a team of people to do it. Most of my friends in the industry said, "You're nuts. How are you going to be able to compete with the big ETF issuers in the marketplace?" But I've always kind of been a big believer in no matter how crowded a space is, an industry is, if you put together a good business plan and if you execute it well, you can find success anywhere. And so what I decided to do was, first of all, put together my team. And one of the advantages of being in this industry for 20 plus years is you get to meet a lot of great people along the way. You get to also meet some not so great people. So you bring the great people into your team. You start working on the products. And when I started putting the products together, what we really wanted to do was be very differentiated in our products. We recognize that Canadians don't need another S&P 500 ETF,
right,
or another TSX 60 ETF. Where we identified the true opportunities was to take a look at things like specific areas of technology, take a look at things like covered call strategies, which I know we're going to be talking about today, take a look at traditional fixed income, crypto, and things like that, and build a very well diversified platform. And it's worked for us. We just crossed our 5-year anniversary last week, actually. We're sitting at just under 3 billion in assets, about 2.9 billion. Today, we've been one of the fastest growing ETF providers in the country. In fact, this year alone, we have grown almost 45% in our assets. So as you know, and as I'm sure all your viewers know, this has been a very challenging year. So we're pretty proud of what we've been able to achieve so far.
Perfect. Well, listen, thanks a lot. I really appreciate it. So it sounds like you have a ton of experience. I recognize a lot of the names: Fiera, WisdomTree, Horizon. So obviously you have a lot of experience in this space. So thanks so much for that. So as you know, we discussed this earlier off camera, but the bread and butter of my channel, my platform, what I invest in is covered call strategy. So that's what we're going to be really focusing on today. And you guys have a really nice lineup of unique covered call ETFs, which we're going to talk all about them. But before, just as a general sense in today's market right now, I think about how happy I am that I am a buy and hold income investor who has covered call ETFs, because in this kind of environment, that's, covered call ETFs, as we know, they perform better during this type of market. So give me an overview of how you feel right now about covered call ETFs. I'm assuming there's more interest in them. They're getting a little bit more popular because of those market conditions you just spoke about, right? Difficult market conditions.
Yeah, so interestingly, from a stats perspective, there's been about $20 billion of new flow into ETFs this year, of which about 10 billion is into equity strategies, of which about 3 billion has been into covered call ETFs. So almost 30% of all of the equity inflows has been into covered call strategies. So this has been a blockbuster year for covered call strategies. So let's maybe think about why that is. Well, when do covered call strategies work? They work in, and I'm sure you've covered this many times in the past, they work in upward trending markets, slightly upward trending markets, flat markets, and slightly downward trending markets. Up until this year, we were in the longest secular bull market in history. And so when you have constantly rising equities in a bull market, 9 times out of 10, you are better off owning the equity instead of having a covered call overlay on top, because that's going to potentially cap some of your upside risk. So a lot of investors up until this year said, well, why do I like the income? It's attractive, but why would I want to have any cap on my potential upside of an equity strategy? And so 9 times out of 10, you actually underperform through a covered call strategy. But now it's different. This year has obviously been very challenging in the market. But beyond that, I think most investors feel that over the next few years, we are going to be in one of those types of markets that I identified, slightly upward trending, flat, or slightly downward trending. I don't think a lot of people are expecting the next couple of years we're going to be in a massive bull market. So that's where covered call strategies can shine. And that's one of the major reasons why we've seen so much more inflows into these strategies, because you're potentially cushioning some of your downside risk. You're generating tax efficient income from the option premium, but also hopefully from some of the dividend income. It's been working really well for investors, and obviously there's been a lot of interest.
Yeah, I love what you said there. So, I mean, in a strong bull market, we know that covered call ETFs will underperform. There's that drag, right? Because you could be called away. But during a flat market, during a more volatile market, things are much different. And this is where these products could shine. And the way I explain it to people is I'm actually a pretty pessimistic investor because I am all in with the covered call ETF. So I am always willing to give up potentially that that upside during a strong bull market, but I want the ultimate safety and consistency all the time. And it's a very easy to be an investor during a bull market, but it's really when things go bad is where you start learning the strength of your portfolio and what you're made of. So we're going to be talking about covered calls a lot today. I know we have other ETFs, thematic ETFs, but I really want to focus on covered call ETFs here. So as we know, the two major factors when it comes to any covered call strategies, portfolio coverage and the moneyness of the option. So from what I gather or what I saw on your website, it seems like you guys have an option strategy where you do up to 33%. So can you speak a little bit about Evolve ETFs specific covered call strategy, and how does it compare to maybe other providers? I know you can't really talk about that, other providers, but tell me how Evolve thinks about their covered call strategy.
So the way we look at our covered call ETFs, typically not all of them, but the majority of them, we have two components. We have the portfolio, as you said, so the investable equities, and then we have the covered call overlay. So on the portfolio side, you can either have a passive portfolio or it can be actively managed. On the covered call side, you can either have a systematic covered call strategy, which I'm sure we'll be talking about at some point, or an active covered call strategy. So between those four options, you can have different iterations of covered call ETFs. Right. What we have opted for is a passive portfolio of underlying equities. Typically, we do have one fund that's active, but for the most part, our covered call strategies have a passive portfolio and an active covered call overlay. So on the passive side, what we do is we have an index and we will take a sector. So our largest covered call fund today is our healthcare fund, which ticker is Life. So we'll have the 20 largest global healthcare companies, and that is measured by their market cap and rebalanced and reconstituted every quarter. Okay. That's the index. And then we will have an active covered call strategy, as you mentioned, on up to a third of the portfolio, where that's typically rebalanced on a monthly basis, but could be rebalanced in other periods as well. We are huge believers in having an active covered call strategy versus a systematic covered call strategy. Let me kind of explain, if you don't mind, what the difference is. So please. An active is pretty self-explanatory. It's where a manager has the discretion to determine what stocks in the portfolio they want to have covered or write calls on, and what percentage of those stocks they want to write calls on. A systematic approach is you just go a third across the portfolio and you are covered at all times and you're rolling on a monthly basis. Both strategies are typically selling calls or writing calls on options that are typically 3 to 5% out of the money, but a systematic has no discretion attached to it. It's a robot that's effectively just rolling the calls every month, or potentially you're out of the money and you're called. We don't think that makes the most sense. We think you need to have a little bit of discretion. So when I put Evolve together, there was a couple of people that worked with me at Fiera. One of them was very senior in the derivatives group, and I remember sitting down with him at Fiera and spending time with them and realizing this is the only person that I've ever met who's been able to consistently make money for investors utilizing a covered call approach. So when I set Evolve up, he was one of the first people that I said, I have to get, his name is Steve Pate, I have to get Steve onto this team because he's that good. And so he runs that team, but we have a couple of other people that support him. What we have seen, and ultimately what you have to translate this into performance, is that all of our active covered call funds have outperformed a systematic approach by about 10% since the fund started. So if our fund started 5 years ago, roughly, like our healthcare fund, our active approach has resulted in 10% better performance than a systematic approach would have. So I'll give you a great example of alpha generation in covered call strategies. We all remember when COVID kicked in March of 2020. Obviously, the markets went haywire. Steve and the team said in April that volatility was through the roof. The options were incredibly expensive and started to see signs that the markets were starting to rebound. So he took off a lot of the calls on the portfolio and so let the equities run without capping much of their upside. And that was a huge alpha generator for the fund back then. And that's the kind of discretion that you have if you understand the options market. If you're looking at volatility, interest rates, performance of the portfolio, you can actually generate some pretty significant outperformance versus a systematic approach. On the security selection side, we tend to think that a passive approach makes sense. I mean, you've seen the data. Most passive indices have outperformed an active strategy, especially when you start looking at large cap securities. And you have something called the SPIVA report card, which is the S&P report card, which typically shows that 90% of active managers underperform their benchmark net of fees. So we decided to take a passive approach there, but an active approach on the covered calls.
Interesting. Very interesting. It makes sense to me, right? So you basically, what you're saying is passive on the stock selection, whereas you'll typically stick with the same stocks. And that makes sense to me because from what, all the experience that I've gathered over the years, I started realizing that a lot of it's always the same stocks typically in right. So what's really the point of getting in and out of stocks? Like you said, the indexes, which typically always outperform. So basically you guys are very passive on the stock selection, but you're a bit more active on the covered call writing, which is interesting. Like you said, if you think there's going to be a big run up, you'll slow down the covered calls. You have that flexibility compared to someone else. We won't mention names, but there's the biggest provider out there. It's pretty much set in stone. They do up to the 50% out of the money. So you're more active management means you actually have a chance to do better performance, and that actually has paid off for you guys. And it is one of the first things I noticed when I looked at your ETFs, the performance, pretty good compared to other same ones. Pretty high yields as well. So now let's get into my favorite part. Now let's talk deep dive here on some of your great ETFs, which I feel some of them are very unique, which I feel is really cool. So we'll talk about the first one that really stood out to me, BASE. So BASE is your materials and mining covered call ETF. So the reason I found it unique, and maybe you could comment on this and make me understand. I actually have two questions about this. I always wanted to ask an experienced fund manager. There's a lot of materials covered call ETFs out there, but they seem to be only gold producers or precious metal producers. You guys did something different where, yes, you have a couple of gold producers in there, but you also have steel, aluminum companies, chemical companies. It's a very unique covered call ETF I saw on that. So what's your idea behind this ETF? Why didn't you just go precious metals? Why did you add that other stuff?
Yeah, so maybe give you a bit of a bird's eye view into our product construction, because it's probably worthwhile.
Of course.
We kind of have a couple of ways that we put our products together. One is we come up with the idea ourselves. So we're market students. We take a look at the opportunities in the marketplace. We identify if there's a gap in the marketplace, and then we go out there and put the product together. But we always have to identify that there's a gap and there's a need for the product. That's because there's a gap doesn't mean that anybody's going to want the product. The other way that a lot of our product generation takes place is from our clients. And typically our clients are investment advisors across Canada, where they approach us and say, "Hey, Raj, I really need this product because it's a gap in my practice, and I'm sure that I could use it. And here are the 5 different ways that I could use that product." And then we take that and we bring it back and we say, is this a good idea or is this a bad idea? And if we say it's a good idea, then we go and test it out with a few of our other clients to find out whether they like it too. And then we obviously will take a look at whether this is a true gap and that we've determined that there's a need. BASE is a great example of that type of formula that we followed. We had a number of advisors that approached us saying to us, look, we want to have more exposure to the materials and mining sector, but we have enough exposure to Canada, and we already have a lot of exposure to gold. So can you put a product together that gives us more, first of all, global exposure, and second of all, a little bit less exposure, although we want to have a little bit, but a little bit less exposure to gold. And so base, again, another index-based strategy. We take the 20 largest materials and mining companies in the world. Many of you know them, the Rio Tintos, the Kodaks, Eastman Kodak, that kind of stuff, and Alcoas, and they make up the index. And then we write calls on up to a third of the portfolio. So right now, obviously you have nothing in Canada because it's global. So it's a nice complement, fills a gap for advisors' practices. And right now you're about, I think, 38-40% steel exposure, about 10-12% exposure to gold. So between steel and gold, you have close to 50%, as you said, specialized chemicals and so on. So it's a very well diversified product, and it fills a gap because it's complement to your existing Canadian exposure. And the yield's pretty high. I mean, this fund's a great example of a fund that has been able to significantly outperform versus a systematic strategy by about just over 10, I think it's about 12% that we've outperformed. So significantly outperformed, but it's also outperformed the index. Because remember, one of the other interesting nuances for us is because we have an underlying index and then you have an active covered call overlay, if we take a look at our fund's performance and compare it to our underlying index's performance, we can actually delineate what kind of alpha the covered call strategies have been able to generate, right? So we have a very simple way to do that. And, historically, very difficult. As we said at the beginning, in a long-term secular bull market, 9 times out of 10, you were underperforming the equities if you had a covered call overlay. But this year, most of our funds have been able to outperform the underlying index because we've had volatility and because covered calls generated. And base is probably the poster child for that.
Cool. So what you're saying is basically, to my audience here, in case you didn't catch that 100%, that in base you have, first of all, great diversification, all materials type of stocks, but the covered call writing, compared to just owning the index without the or the stocks without the covered calls, you're saying you actually outperformed with the covered calls, which is actually pretty hard to do and very hard to do because we know that covered call strategies typically have a drag on return. So that just tells me you guys probably have a really good covered call manager, and we'll talk all about that later. But the next ETF I want to talk about, so yeah, base, really cool ETF, definitely the first one that got my attention right away just because of that uniqueness with the composition. Really cool, definitely unique out there in the market. Speaking of unique, EBNK. So EBNK, this is the only covered call ETF that focuses exclusively on European banks. So there's a million of them on the Canadian banks, obviously the US banks. But here's another example of a really cool, unique ETF that caught my attention. So give me the idea of why you guys created this particular ETF, because all I hear is pretty much negative things around European banks.
What's interesting about European banks is that when Russia-Ukraine war started and until now, I think a lot of people would have expected European banks to have done far worse than they actually have. But this idea came the same way as base, talking to advisors, because we're always asking advisors and we're always asking people, do you see any gaps in the marketplace? Can we identify them and can we fill them? And is there interest or demand for them? And we had a number of advisors saying to us that they felt that now was the time to start looking closer at European equities. And while there are some European equity ETFs, there was not an ETF focused on European banks, let alone an ETF focused on European banks with covered calls. So when we started to do a deeper dive into European banks, what we really liked about it was probably 2 major things. One, historically, the correlation between European banks and North American banks has not been incredibly high. So can serve as a bit of a diversifier. 2, European banks are much cheaper from a stock price performance. So a price earnings ratio, for example, for European banks is about 7 times. The PE ratio, or price earnings ratio, for Canadian banks is about 9.5. For US banks is about 10.5. So ultimately what I'm saying is that European banks are about 30% cheaper in value than North American banks. So if you believe that as interest rates rise, that banks will do better, then here you have a group of banks in Europe that could potentially do quite well from a rising interest rate environment, which should translate into hopefully positive performance. So that was the reason. It didn't exist We saw it as a diversifier for existing. If you already own Canadian banks, if you already own US banks, European banks can provide a bit of diversification. They're a lot cheaper, and the call premiums are lucrative enough. The difference between eBank, which is the ticker EBNK, and our other funds is, without getting into too many weeds here, most options, as you know, are traded on an exchange. But with European banks, we have to trade them over the counter, which means they're traded privately between the banks, for example. So because of that, we do not take an active covered call strategy approach to that fund. It is actually a systematic that is actually rolled every month. That's the only major difference.
That's what I was going to actually ask you. How's the options market in the EU? Because believe it or not, I have quite a few viewers, maybe 5 or 10%, which is, you know, surprisingly high to me, from the UK, from Germany, Switzerland, and they're always telling me, Adrian, there's no covered call products in the EU markets. What do I do? And I tell them, you know, try to get access to the at least to the American stock market. I have no knowledge. So my question to you is that it was about the options market in the European exchange. So you're telling me they have no options market? It's over the counter?
That's right.
Wow, interesting, very interesting. Well, and do you know why? I mean, why is that? Why are options and derivative? I heard they're very frowned upon with the EU regulators, and they don't allow these things. And
yeah, I'm not an expert, but I would say so. I think one of the things you'll find as well, and you know this, Adrian, like the covered call strategies are not like covered call ETFs, for example. They're not a big thing in the US either. They've become quite big, or becoming more prominent in the Canadian market. But in other parts of the world, they just haven't been needed. Now, I think going back to what we talked about at the beginning of the new environment that we're in, I think you might start to see the benefits of them, and more investors starting to use covered call overlays. But I also don't know what the tax treatment is in some of those jurisdictions. I'm sure you've talked many times about the favorable tax treatment for option premiums here. Sure. So I'm not a tax expert, so I can't comment on how they're taxed in the US or how they're taxed in parts of Europe. But it could be a challenge from that perspective as well. But it's not easy. We had to do a lot of work. We had to talk to a lot of the banks about being able to trade the calls for us. So we finally found one that was able, one of the big Canadian banks that was able to do it, and we're happy to be able to bring the product to market.
Cool. Thanks for that. Really appreciate it. And yeah, I mean, taxes is really a big advantage of covered call ETFs, and capital gains is taxed really well. And from what I heard, and this is maybe why they're not as super popular in the US, not as well, because they have long-term capital gains, and short-term capital gains taxed a bit different. Plus, you know, this is just my assumption here, maybe why they're not as super popular in the US, although they're kind of gaining steam. I believe there's a couple of them have come out, you know, Global X is a big provider of them, and there's a couple of other ones. I think they have a humongous and very lucrative fixed income market there. Also, that maybe the covered call ETFs are not as attractive, but anyway, I own the US ones. I really like them. But definitely in Canada, they're a lot more popular. You got a lot more choices out there for sure. So yeah, pretty cool. You know, you touched on diversification. So the first thing I thought of was European banks. Diversification. I'm all about diversification. Very easy to get the North American banks, the EU banks. I mean, this is, of course, you're looking inside. These are all big blue chip banks. It's not like we're investing in anything super risky. And you know, I appreciate you telling us about the discount, that they're actually pretty cheap right now. So something really cool to consider. Definitely one of your newer products. And the question I had forgot to ask you about base, or more along the lines of gold producers. Maybe you could help me out with this, because honestly, I can't figure it out. So they say, you know, you always hear gold producers, it's a hedge against inflation. It should do well when the market's not doing well. That's certainly how they reacted in 2020. But now they're not doing that. So you see a lot of these covered call gold producer ETFs not doing that well. Gold prices, silver prices not doing that well. I would think that it should be the opposite. So do you have any insight on why gold is doing so poorly now when it should be doing well? That's, you know,
but I think you're right.
My brain around it.
I think I think, you know, we often look at theory and history and assume that it's going to repeat itself, and it doesn't always. This is a very different market. I mean, most people were also not expecting fixed income to be such a terrible asset class this year either, that in a downward market like what we've had, fixed income is supposed to be your safe haven. It's not. Right. In a recessionary environment, downward trending market, gold is supposed to be your hedge, but it hasn't been, and commodities in general haven't been. So it's look, I have a lot of I have a lot of sympathy for investors right now, for sure, because it's been an incredibly tough market. It's been very difficult to make money this year. I know a lot of people have taken on some risk that they didn't think was going to be this type of results from that risk. But the problem is, when you have this kind of market it seems to me correlations of everything goes to one, meaning everything is so highly correlated. You see it in technology, where technology sells off. If you're a company that is generating incredible profits and revenue, you're still getting punished along with the companies that have negative profits. It's just all a big vacuum this year. So my only answer to you on gold is history doesn't always repeat itself, and the fundamentals are there. But I think what you're seeing is old patterns not reoccurring.
Yeah, and this is just brings in the importance of diversification as well. And it's interesting that you said history sometimes repeats itself, but not always. So I always preach diversification, just in case, a little bit of everything. Try to be as diversified and as broad as possible, and not to look at the way I explain it is you talked about the technology sell-off, which is, it's a pretty steep sell-off that's happening right now. It doesn't mean that Apple and Google and Facebook, they're losing money, they're doing terribly. It's like you said, it's just a vacuum. It's kind of like sheep. It's like a trend that it just accelerates. So this is why
I think Adrian, what I feel worst about, to be honest with you, is fixed income, because we've always been taught that fixed income is your haven, and so all these investors, that over the last 10 years have missed a part of this equity run, because they were always taught you got to be 60-40, 60-40. You got to have at least 40%.
60-40 that now you hear 80-20 even.
Yeah, exactly. 60-40, you got to have 40% fixed income, maybe even in some cases 60% fixed income, and you got to run with it. And they said, yeah, I'm properly diversified. They thought that they were properly diversified. And then you have 2022 come around, and people are like, I missed out on a bunch of the equity growth over the last 10 years because I wanted to be diversified, because everybody told me that I needed to own fixed income, and fixed income has been terrible this year as well. So I have a lot of empathy for investors today. It's a very difficult market. Sometimes when I watch historians talk about, well, in 1987 market, this is what happened, so we think in 2022 it's going to repeat itself. It's a different world,
right?
It's a different market. So to your point, proper diversification makes a lot of sense, but maybe, just maybe, the traditional definition of diversification doesn't make sense anymore.
Yeah. So this is why I don't watch the news or listen to predictions or what, because it's all you can't predict the future, because even now the trend is different. And this is also why I'm not a fan of fixed income. I don't have any. I'm all about buying and holding long term, if not forever term. So fixed income typically, correct me if I'm wrong here, always underperforms equities over time. So why would you hold fixed income just because you heard that 60-40 rule? For me, it doesn't make sense. I don't have fixed income. I just have a little bit in my retirement accounts, but that's only because the US has some really good leveraged fixed income funds. But in Canada, not very hard, very hard.
No, I'll give you one, and we can move on, because I know this isn't about fixed income, but
no, sure, go ahead.
As you know, we have that HISA, high interest savings account fund.
Yes.
If you look, and these are just deposits with 4 of the big 6 banks, and right now earning 3.74%. You look at that compared to a short-dated fixed income instrument that's actually, many of them have negative performance this year. Even that, you say, why would I want to have any duration in fixed income?
You're better off with just cash. Come on. Yeah.
Anyways.
It's crazy. Yeah, you just proved it right there. This is why, any fixed income that I do have, or is performing terribly when it should be performing fairly well. But
there's nowhere to hide.
We could have this conversation a year from now, and all of a sudden fixed income is doing amazing. I doubt it, but who knows? This is why diversification always comes back to that, right? So, all right. So going back to the covered call ETF. So the 3 ones you have that have been out there longer is base. We talked about it. There's life, the healthcare one you spoke about, but also call, the US banks one. So one thing that I noticed with these ETFs is that they have some very impressive, and I would say even aggressive distribution increases throughout the years, especially base, like base just had a big increase, I think from 16 cents to 20 cents. This is very, very rare by someone who knows all the covered call ETFs in Canada by heart. I have OCD. I just got to know them by heart, and I got to look at their distributions constantly. These are different. I noticed that they're very impressive in terms of distribution increases, which is very rare on covered call ETFs. So why is Evolve ETFs, or why are you guys able to have such big distribution increases compared to other fund managers? And you kind of touched base where you have a really good covered call manager, but explain it to me.
So I mean, the distribution yield is an interesting topic that we have a lot of conversations internally about, in terms of should we be, you never want to reduce your distribution because that's just, unless
I love hearing that. I love hearing that, by the way. I mean, that is number one for an income investor.
You never want to do it because people are relying on this for cash flow. So you never, unless it's absolutely necessary, but you never, I mean, there's a reason why the banks very rarely, for example, will cut their dividends, because sometimes it could lead to a major decline in their stock price. So you never want to cut your distribution. What you always want to be is comfortable that you can earn the distribution via the dividends and via the call premiums. And the reason we increased our distributions in the past, to your point on base, I think we started at 10 cents a unit. Now it's grown to 20 cents a unit.
And I believe in our double.
Yeah. And I think a lot of our distribution rates have actually doubled. I think in rough terms, I think Life, our healthcare fund, has gone from, I think about 7 or 7.5 cents to 14.5 or 15 cents, something like that. So many of them have doubled. So what we've tended to do is fix our distribution rate, but we've increased it along the way because we want investors to have a meaningful yield. And don't forget, as interest rates are rising right now, the opportunity cost needs to be present of what can I get on traditional fixed income versus what can I get on a covered call strategy. So I was talking we were talking this morning about it, and we were saying, okay, Life was paying out a 7% yield when the overnight rate was 25 basis points. Wasn't that long ago, by the way, right? That was a year ago, year and a half ago. And so the delta between that 7 and the 25 basis points was, call it just 6.5%, just for 6.75%. And so now the overnight rate's 3.25%, so it's 3% higher. So should our distribution rate be a couple of percent higher? And now we're closer to 10%. You always have to look at what investors' other options are. And for a covered call strategy, it needs to be more attractive, but you also need to make sure that you can earn it as well. And don't forget, one of the things, the unfortunate side of it is oftentimes your dividend yields in these stocks are higher because the stock price has dropped.
Right.
So the yield has gone up. So if your stock was $10 and paying a 4% dividend, and now it's gone to $8, and now it's probably a 5% dividend rate, it's not because necessarily they increased the dividend. It's because the yield went up based on the fact that the stock price went down. Right. A little bit the same thing with funds. If your NAV is dropping, if your NAV drops, your yield goes up because you're still paying out. You're still paying out the same distribution. So they are attractive yields. We are very focused on them. Pretty much all of them are very close to, if not exceeding, double-digit percentage yields. But we look at all of those types of things, and also we want to make sure that from a market perspective, they're in line.
Okay, so sustainability is important for you guys as well. You're not just overwriting or grinding, so they say. For sure. So you feel that your intention when you raise your distributions is to not to lower them. Is that correct?
That's right. Okay. That's right.
I have to say, very impressed, especially with these ETFs that don't have leverage. Although one of them has, and we'll talk about it in a second. But before that, I just want to talk about your management fees. So another thing I noticed is that your management fees compared to your peers are lower, right? The management fees are lower, and a lot of people are obsessed with management fees. They look at that, and and of course it does eat into the returns a little bit. But we're talking about 100, 200 basis points lower than some competitors. So how come you guys have such have pretty much, I would say, some of the lowest management fees in the business in Canada here in terms of covered call ETFs?
Yeah, I'll go back to business principles as well here. So about 8 years ago, I was involved in the closed-end fund business. I don't know how much you know about closed-end funds.
I know about it.
You do?
I invest in them, yeah.
Okay, so with closed-end funds on the IPO, so on the new issue, Um, Everyone made a lot of money, and then the investors were left with whatever was left over. And so the pyramid was inverted, meaning all the different parties were making a lot from the investors' money, and then the costs were so high
From the fees,
that
you mean the fees you're talking about?
from a fees perspective, that the investors needed to really do well in order to just make a little bit. Meaning, for example, I'll give you a great example. Your issue price for something could be $10, but there's like 7% of fees coming out up front. So now your starting NAV is going to be $9.30. You now need to grow 8%. The market needs to grow 8% in order for you to just get back to what you actually invested, right? So when it was one of my biggest challenges with the closed-end fund market is that it was incredibly lucrative for everybody except for the investor. My favorite thing about the ETF business is the pyramid is on the right side up, meaning that the investor makes the lion's share of the return, and the rest of us, specifically us as the manager, make a small portion of it. And that is the way it should be. And so when we put our products together, we look at what the landscape is. We look at the amount of work that it's going to take for us as well. We look at what the landscape pricing is, meaning what some of our peers are charging for similar funds, and then we'll make a determination. And we also recognize that, of course, we run a business. We need to make some money too. We're not a not-for-profit organization, but we want the investors to make the most. So by charging a lower fee, that means that the net yield that the investor earns is going to be that much higher. And that's key because cash flow for investors right now is super important. So yeah, we're pretty proud of the fact that we've been very frugal with our fee structure to the benefit of investors.
Awesome. That makes perfect sense. Yeah. All right, cool. Going on to another ETF I want to talk about, Bank. So Bank is relatively new as well, very unique. So it has the big 6 Canadian banks and some life insurance companies, which is a great combination. But it's the only covered call ETF in your lineup right now that has 25% leverage. So, my bread and butter of my portfolio strategy is covered calls, right? Diversification. But I also like leverage or modest leverage because if you're going to buy and hold something long term of quality, you might as well have a little bit of leverage on it to squeeze out more yield and more return. So are you thinking of, tell me a little bit about Bank and why you decided to put 25 leverage on this one specifically? And do you have any plans on maybe coming out with leveraged versions of your current ETFs, which, as you probably know, many fund managers are starting to come out with these type of products?
So, yeah, it's a great question. So we've been exploring this whole leverage wrapper for one of the banks brought it to us maybe 2 years ago. And we found it kind of interesting, but we weren't sure that we wanted to do it. And then I guess about a year ago now, we said, if we're going to do this, 2 things. Number one, it needs to be modest leverage, okay? I'm not interested in launching a 100% levered product that investors could potentially blow themselves up in because they don't buy the right product or they hold it too long and so on. So it's got to be modest. So 25% leverage. And most of the levered funds I think that you're talking about are similar.
25%,
25% leverage. That was number one. Number two was, if we're going to apply leverage, it needs to be applied to something that when interest rates are rising, because your leverage cost is going to increase. When interest rates are rising, your borrow cost goes up, but it should have a positive impact on the underlying portfolio,
which are banks in this case, and insurance
which are banks and Lifecos. So most people know that banks do well typically, historically. Now, again, we just talked about how history doesn't always repeat itself, but historically, banks do well in a rising interest rate environment because their operating margins, their loan books grow, their operating margins increase. So what they make off of lending money is that delta is more than what they have to pay out for deposits as well. So typically speaking, it's positive for the banks to be in a rising interest rate environment. Typically speaking, it's also positive for insurance companies to do well in a rising interest rate environment because all those policy premiums that we're paying, what the insurance companies typically do is they invest those into interest-bearing investments. So rates go up, they're gonna do even better. So normally both those areas grow. So that's good. If you apply leverage to the wrong asset class, it can be dangerous, especially when you have a rising interest rate environment. So when we started the fund, I think interest rates were the overnight rate was 1%. That's right, it was 1%, and so the borrow cost was a small premium above the 1%. Not so bad, but now the borrow cost is a lot higher. Now the borrow cost is closer to 3 3/4 and 4. So what you really want to do, my only suggestion is if you're ever looking at levered type of products, is you want to also recognize that it can be a double-edged sword, and the underlying portfolio should be something that you can rationalize, can actually do well in a rising rate environment because your borrow cost is going up,
right,
on your leverage, and so you want to be able to offset that increased cost by better overall performance over here. Does that answer your question?
Yeah, it does, and it makes total sense. That's why you're doing it on banks. So any immediate plans? I know fund managers can't discuss their future products or anything like that, but are you considering other leveraged products in the future? I mean, my next question was going to be, I might as well ask it now. There's currently all-in-one covered call solutions out there. These are very, very, very popular with myself in the community because it basically takes a bunch of covered call ETFs of different sectors, different themes, and then slaps 25% leverage on top of it. So you have high yield, with that little bit of leverage. You have the covered calls. You have instant diversification. So are you guys looking at any of these types of products, maybe combining the Evolve covered call ETFs into one or something like that?
I like the idea. I like the concept. I think the issuers that have launched them are good. I think from an investor perspective, you should just always be aware of what the underlying funds are and how big your MER is potentially going to be, because if the issuer is using external funds, then the MER is going to obviously be a little bit higher. But listen, look, on that vein, I was talking about cost before. You do have to also recognize, sometimes you pay what you get what you're paying for it. So if there's value add in a higher MER because it's better underlying products, it's worth it oftentimes. So that shouldn't be the major gating item. I think too many, as you said earlier, I think too many people are a little bit too focused on MERs. I think if it's a commoditized product, I think it's important to look at MERs. But oftentimes you're getting better quality for a higher fee. I think paying up a little bit for better quality makes sense. I mean, it's like buying a Gucci purse versus a purse from Walmart. I mean, it's higher quality, so it's going to cost more, and you're paying for a label.
It's only normal, yeah.
It's only normal. So, I think we oftentimes get too wrapped up on the fee side. Going back to like the whole product construction for us, I know we talked a lot about it in this discussion, but how I said, we come up with a product idea, or we find it from an advisor. Sometimes we bake it ourselves. We go and test it out. I think in this case, for example, I'm actually kind of surprised at how well these products have sold, these kind of one-stop solutions. The only answer I would give you is we may do this if we figure out a way to do something better, or figure out a way to differentiate it in some way. We're typically not interested in launch like a concept like this, just launching something identical to everybody else, because then we sit back and say, well, why would people buy ours when you have this other one that's been in the marketplace for a year, 2 years, 3 years, and has performed fairly well? We always need a differentiator for everything that we do. All the products that we talked about today, there's all a differentiator involved in it, right? There was no global materials and mining products with covered calls.
European banks.
There was no European bank. Like, we always want to be different in the marketplace. We're all for taking an existing idea and trying to figure out existing product and seeing if we can come up with a better solution and bring it to market. That's what creates a free market environment that we're all in. But we haven't figured that out yet for that area.
Okay.
But good for investors and good for the fund companies for having so much success in that category. We're watching it. We just haven't figured out how to enter it.
Awesome. That's pretty cool. Thanks for that. Appreciate it. And yeah, it's already been an hour. Time flies. It always flies when I speak to fund managers. I just could speak to you guys literally all day and ask you a billion questions. But last question, and we discussed this off camera. You saw a recent video of mine, cash savings ETFs. And there's a few of them out there, but yours stands out because it has the lowest management fee and a really high yield. And you even have a Canadian version, you have a US version, so you could actually get 3% or plus yield on your cash with only a management fee of 0.05. That's the lowest. But it seems like that this special is going to end at the end of the year. So tell us about these ETFs and the premise and the concept behind them.
Yeah, so we launched this product a few years ago. And as you know, there's a few of them that exist in the marketplace. They're very simple. We take the proceeds of the fund, we deposit it with 4 of the big 6 banks. So we're not depositing with small banks. We're depositing with 4 of the big 6 Canadian banks. We're earning the overnight rate, which today in Canada is 3.25%. I know that's crazy, but it's 3.25%. That's the interest rate environment that we live in. Plus above that, roughly above 49 basis points. It's typically 50 basis points. One bank's paying a little bit less than 50, so it's 49 basis points. So right now, the yield is 3.74%. And you're quite right. One of the things that we decided to do was lower our management fee a couple months ago for a couple of reasons. Because this is a commoditized product, because there's a few options.
Right.
Ultimately, the product that should bring in the most should be the one that's got the highest yield. Especially if all things are equal, they're all depositing with the same banks. The only way to get a higher yield is for us to charge a lower fee, because the banks are not necessarily going to give one ETF a higher yield and another one a lower. They've been very fair and equal on that board. So we're all receiving the same yield. The only difference is our fee is typically close to 10 basis points lower, which means that 10 basis points it goes to the investor. So in that case of 3.74% gross yield, the net yield to the investor is 3.69%. And then every time the Bank of Canada announces a rate increase, so let's say the next one in a few weeks is another 75 basis points, the next day, your yield in this fund goes up on an annualized basis, of course, goes up another 75 basis points. So it moves in lockstep with the Bank of Canada overnight rate. So to me, this is a great product. It's daily liquidity. There's no penalties or redemption fees attached to it. I remember in your webinar, I think one of your comments was you're not sure what our fee will go back to in January.
Yes, that was going to be my next question.
Yeah. So our normalized fee is 15 basis points. That's the fee pretty much all of them are charging. So in January, we would go back to our normalized fee. So it would go to 15 basis points. Still, obviously pretty cheap, but it's cash. So you can't really justify charging a high fee on cash deposits. But yes, this year has been the year where cash is king, obviously, in this market. There's been a lot of inflows, not just into ours, but into all of the products. It's been a great asset class. And, as I mentioned before, you compare it to traditional fixed income. I mean, I've seen bond portfolios that have, anywhere from a 3-year to 5-year duration with the same yield. And you've got principal at risk in this case. So in that case, in this case, these are deposits with the big banks. I think if you're worried about the banks not paying and potentially becoming insolvent, we're going to have way bigger problems to deal with.
Some people ask me that all the time. What if the big 6 banks fell? Well, they've been around for longer than me and you and your parents have been alive. So
ever will be.
What if a meteor hits the Earth tomorrow? That's usually how I respond to these types of questions. But this is pure super safety. And these funds all look the same to me. Look at the stock price; they're always about $50 all the time. So it's pretty cool that you could, instead of just leaving it in the bank and who has the best interest rate, you put it in one of these. You always have the best. And like you said, if there's a rate increase, it's the next day you get the benefit. And you could, I noticed that all of the products, if you look at the monthly distributions, another reason why it's cool, monthly distributions, of course, it's all interest income, right? Or I'm assuming mostly interest income. They're starting to go up significantly in the last couple of months. So, hey, if you want to park some cash, I personally don't. I just reinvest everything I can every single month after my expenses are paid. But that makes sense for a buy and hold investor. But someone who's in the market, for a couple of years, or they have a smaller time frame, not forever like me, well then, this is a great option. And you guys also have a US one as well.
We do. And as you saw yesterday, the Fed's announced a 75 basis point increase. So the yield on that fund for US dollar accounts, which a lot of people have, is 3.45%. Also only charging a 5 basis point management fee, so it's 3.4%. But to your point, which is an interesting topic, I'm older than you. but I remember when my dad was buying a lot of real estate in the late 80s. And I remember interest rates back then, like mortgage rates back then, interest rates back then were 17, 18%.
Yeah,
I remember
yeah.
GICs back then, 11, 12, 13%. At what point, out of curiosity, it's not really a question, it's more rhetorical, but at what point do GICs and let's say a HISA fund like this get to a rate where people say, I don't need any more. I'm good. I don't need to take, if I can get 8% a
Right.
year, maybe I don't need to take any equity market risk. I don't know
Yeah.
what the answer. I don't know what the answer is. It's probably a different answer for for everyone. But there is a certain point where like now rates have gotten to a point, right? You can get 3.75% on cash, and GICs. You've probably seen some GIC rates 5 year for like 4.5, five
Yeah,
and a half
yeah. I made
percent.
a video on GICs as well. Yeah.
Right. And so at what point do rates get so high where people say, I'm parking it? I don't know.
Yeah. Well, I think people do this, and this is why equities are suffering right now, especially the technology sector where it's all about that growth. There's not much yield there, dividend yield typically, and this is another reason why I just go cover calls with everything, including technology.
Yeah.
But I try to tell people, you always think long term. I'm always thinking long term because things could be extremely different in 2 3 years from now. Maybe we'll start going back to lowering the interest rates and the economy will pick up again, and that's again the growth stocks and equities are going to outperform everything.
Yes.
So it's an interesting point. It's always that balance, and the stock market, stock prices, I always feel like it's based on human emotion, on what's going on, a human condition. There's a lot of herd mentality there.
You got it.
So I
Well, the
always
market
say
is driven by two things, right? Fear and greed.
fear and greed. You're right.
Guess which phase we're in right now.
I pretty much, I think everyone knows there's
Yeah,
fear in the streets everywhere. So
that's right.
yeah, I mean, this is why I'm a long-term investor. This economic system that we're in has always been boom and bust, up and down. So why panic now and start? This is why I just typically just hold equities long-term, because what history has shown us is that it's always going to go up long-term.
Yeah.
Hopefully that continues to happen, but I'm a bit pessimistic. That's why I have the covered call stuff.
Good for
So
you. And sorry, one last thing, because I know we've run
sure.
out of time, probably a long time ago. But always when you're looking at a covered call strategy, make sure
Yeah,
you really like the underlying portfolio too. I know that sounds like a very, very
it's number
elementary,
one. I always tell
but
people it's number
yes,
one. The quality of stocks, if they're blue chip companies that have been around for long terms, if they have plaques on buildings and their buildings look really really nice and pristine, for me that's the signs that I look at. Especially I work downtown, so I mean, who has the nicest and biggest best buildings? It's always those big blue chip powerful companies. These are powerful companies with a lot of money, a lot
yeah,
of talented people on the board. So that's always number one. Forget about covered calls or ETFs or whatever. That's Forget about the ETF or the ETF provider. That I always say they're just the middleman. You got to look at the stocks. That's what
you
you're
got it.
actually investing in, right?
And the sector,
The
Do you
sector
believe
as
in the
well. Yeah,
sector? Do you believe in growth? Like, we've had a lot of conversations lately. Our healthcare fund, Life, is our biggest fund, and most people view healthcare as a recession resilient sector.
defensive. Yeah,
Defensive. I mean, history, as we've already said, doesn't always repeat itself, but history shows that it's fallen far less during a recessionary environment and recovered much faster. We all know we have an aging population. We all know how much money is being spent on meds and
yeah,
surgical procedures. We know the growth of the emerging market middle class, all the demand that's going into all the different services. So you can check so many of those boxes and say, in a recession, if we're going to enter one, people still need their meds, people still need their treatments and procedures and so on. So if you think that a healthcare sector is going to do well or better than the other ones during a recessionary environment, and you like generating tax efficient income, then maybe a healthcare fund with covered calls makes a lot of sense. The same approach that you look at for European banks or for technology and so many other sectors. I
yeah.
think it's very important to be able to take a bit of a macro and micro view on the underlying portfolio.
Awesome. Well, Raj, listen, you stay with me longer than an hour. I really appreciate it. It was a great conversation. I always love talking to fund managers. Congrats on your success.
Thank
You
you.
have some really cool covered call ETFs, and I'll definitely be keeping an eye and monitoring. And now that we have each other's contact info, you have a new product, especially income oriented, let me know. I got to know about all of them. So thanks
Awesome.
again. Really appreciate it. And hopefully you come back on the channel soon. and to discuss further.
Thanks, Adrian.
Thank you so much for watching, everyone. I really appreciate it. Don't forget to hit that thumbs up button, that like button, and make sure you're subscribed not to miss out on my future content. Of course, hit that little bell next to the subscribe button so you're notified for any new content that comes out. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once, which is awesome. So this is a companion tool. It's a reference tool that will help you build your own portfolio according to your needs and goals, and it covers both the Canadian and American and US stock markets. So make sure to check it out. I have a video explaining from A to Z exactly what the product is. I showcase it, so there's no surprises. If you're interested, make sure to check out that video. Also, right there on my website on the homepage, I do offer a one-on-one coaching session with me. So this is a 1-hour Zoom call with yours truly for in case you need personalized help. I'll answer all your questions and I'll help you best I can. Just remember, I'm not a licensed financial planner or financial advisor. These are just going to be friendly conversation, right? It's just going to be my opinions. But if ever you're looking for that personalized touch, that personalized help, you could book a one-on-one with me. Make sure to check out the message on top of that calendar. That will give you a status of my bookings for that month. Also, we do have a Facebook group, great Facebook group, over 12,000 members. So make sure to join our community. The group is called Passive Income Investing, a nice Facebook group where everyone is sharing their thoughts and opinions and sharing their experiences. So it's a really nice group. We make sure to stay on top of the scam and the spams, and we delete those right away. So make sure to join our Facebook group. If ever you want something more personalized with us, you could follow us on Instagram. That's where we post more personal things on our adventures here in Panama. So follow us on Instagram if you want. And how do I always leave you? Continue to stay safe, continue to stay healthy, and of course, stay passive. See you next time.